Please welcome our next session, Blockchain Monitoring for Institutional Risk Management.
So, good morning, everybody. An honor to be, opening this convention. I'm Chen, this is Brian and Aaron, and we are from EY's Digital Asset Blockchain team, technology consulting. We've been, as I'm sure at least some of you know, adamant and fully committed to this technology more or less since 2016. Let's start with the why we are here and why we are doing what we're doing. And that is because we believe that public blockchains and Web3 technology and the entire notion of democratizing money is something that is worth doing and worth creating. And we as EY are fully committed to seeing this future become a reality. In terms of what it is that we are doing, we are working with crypto natives and traditional finance organizations, traditional consumer organizations alike in order to develop this technology, deploy it, do it. And I think that's a part of why we are giving this session, do it in a regulated, safe manner that will promote this future. I think that one of the things that is important to say in terms of what we're going to talk about here, this session is going to focus on how do you manage risk over public blockchains. It's important to recognize that at least in the US, we're seeing a lot of our traditional finance clients shy away from interacting directly with public blockchains due to the current regulatory atmosphere. And a lot of what we're seeing is deploying on private blockchains, but what's important to understand is that the way we do it is highly adhering to the public protocols, the public standards. So as a regulatory environment defrosts and the inevitable happens, these organizations are ready to migrate to the public blockchains that are, again, as we all agree, I believe, are an inevitable future. I would just end by saying that last week we saw MiCA approved in Europe. We're seeing a lot of regulatory good things happening, not necessarily in the US, but generally, and we believe, again, that is an inevitable future. When we talk about how you manage risk on public blockchains, Brian, maybe you can break it down for us.
Sure, absolutely. So for context, as Chen was mentioning, the focus of our discussion is around the enterprises that are building on public blockchains. So within these organizations that are building on chain, if they're established organizations, they likely have enterprise risk management frameworks, and there's an uplift that is typically required as it relates to those frameworks. Or for more nascent or up and coming organizations, as they're building out these risk capabilities from an enterprise risk perspective, foundationally making sure that the digital asset and public blockchain infrastructure attributes are embedded within those frameworks as they're being built, rather than being built bolt-ons after the fact. So when we look at what organizations do from an enterprise risk perspective or specific risk stripes individually, you have capabilities like vendor due diligence processes, new product approval processes that they're established. Your organizations are not reinventing the wheel as to how those work, but making sure that they are bringing in the right skill sets, the right talents, the right tooling to make sure that you're effectuating those capabilities appropriately for engaging with these products. When you look at risk, you have the risk identification, risk assessment, you have prioritization, mitigation, reporting. These are critical risk capabilities that are enabled by having the right tooling. And we'll talk about a little bit more on that shortly. When you look at what we have here, the attributes of public blockchains, two in particular being the decentralization of infrastructure as well as smart contracts. They present numerous benefits, but also quite a few challenges that organizations need to overcome. You have, we're here all this week, and we recognize the benefits of blockchain and the promise. A lot of that stems from shared systems. The fact that through shared systems, there's a reduced cost of verification in an ecosystem where you don't have all participants needing to repeat manual processes, right? The benefits there also present some challenges in terms of how organizations need to interact, because it's dissimilar to how they may leverage infrastructure today. Public blockchains are internet native, so you have anybody that has access to an internet connection can access these systems. And then also these tend to be more resilient, or at least can be designed to be more resilient by the fact that there's not a centralized counterparty, right, or a centralized intermediary, and there's not a single point of failure. So with each benefit, there are challenges for organizations to overcome. We'll talk through some of those, how organizations are approaching that shortly. But the fact is, organizations need to realize that the onus is on them to internalize what those challenges may be and how they, based on what asset they're engaging with on chain or product and service that they're deploying on chain, what they need to do. So next, we'll talk through how some organizations are addressing these challenges. You have, from the perspective of decentralized infrastructure, there's no SLA for the Ethereum blockchain. You can't say that you're going to contract how the uptime of the network, right? That's dissimilar to how you engage with a vendor today, right? There's no Polygon customer support line to call when I have a challenge with something that I'm deploying on chain, right? And let's be real, organizations are not in a position where they're going to go on Twitter or Discord with any level of scale to get support, right? When it comes to smart contracts, you have the smart contract code, as some would say, being law. Code is law because it's immutable. Once a contract is deployed and it is transacted with on chain, you can't revert, right, easily. There's no universal legal standard where there's legal precedent broadly, globally, to establish that smart contracts equal a legal contract, right? That's a unique challenge. You have security risks that are numerous, and let's be real, they are numerous. You have DeFi protocols that have been hacked, bridges that have been hacked, right? And organizations might be hesitant to engage with these sorts of products and services because of those risks, some of which can be mitigated, right? The punchline here is we fully expect that with time, there will be tooling that will be so standard, just as the concept of an enterprise using a firewall or an enterprise using antivirus software as a part of their BAU security tech stack. There will be monitoring tooling and tooling that an organization will utilize when engaging with public blockchains that make it so enterprises and their customers, institutional or retail, feel comfortable interacting with these products. So what we'll get to next is we'll start talking through how institutions are responding to these challenges from when you think of controls. Controls are typically corrective. After something goes wrong, you fix it. Preventive, when you look at how do you reduce the likelihood of a negative impact affecting your organization. And these can be things like doing smart contract code reviews. So before your organization interacts with a smart contract, there's a level of diligence that's been done on the underlying code itself. So using their industry tools that exist today, including EY's own smart contract review tool, to make sure that you have comfort before engaging with a given contract. Things like token due diligence, to ensure that you have reviewed not only the token contract, but the development team who's deployed that contract. What are the underlying tokenomics to understand what are the triggers that can be pulled to change the contract itself, and how much is on the market potentially, right? And all sorts of legal and regulatory considerations around a given token. And then also segregation of duties, which is typical within organizations, but making sure that you can't have individuals either within your organization or even externally taking certain actions that may be malicious or unintentionally impact your organization and how you're engaging with these assets. But our focus will be more so on detective. So from the detective perspective, how can you find, seek out, detect network issues that may impact your organization's product or service or asset that you've deployed on chain? These aren't static, these examples of what I've run through, but what's important here to note is we're seeing increased movement, not just from the detective, which is after something's occurred, but how do you get more so into the preventive as well? And that's where there will be a whole host of maturation that'll occur in this space. So next, I think, Aaron, you'll take us through what do we mean by detective, and also in particular as it relates to real-time monitoring.
Awesome. Yeah, so as we look at, from a detective lens, as we've worked with clients both in the traditional space as well as the digital native space, what we've seen is really 4 types of detect monitoring capabilities. We break them out into network monitoring, transaction monitoring, smart contract monitoring, and asset monitoring. We'll get into a little bit of specifics of what we mean by each of these types of monitoring. We acknowledge at times there may be some sort of overlap. I think one key thing to note just right off the bat is it's very dependent on how you leverage the public blockchain infrastructure, what products and services you're deploying. Are you deploying smart contracts onto a network? Are you relying on the network for settlement and execution? Are you just investing in assets related to the network or companies that may have smart contracts on the network, things of that nature. So it's very dependent. Not every single institution is going to have to do all of these types of monitoring. And it's very dependent on, you may use third-party infrastructure providers or critical service providers that may have responsibilities to conduct some of these monitoring aspects, which you may need to understand. I think what we've seen over time is when you hear the term monitoring, everyone's mind flips to compliance related to monitoring, blockchain analytics related to transaction monitoring. So you think about all of the elliptics, the Chainalysis, all of the high-end analytic shops that have been around for a long time. Those are really focused on, from a compliance lens, how do you screen transactions and wallets to make sure you comply with all the laws and regulations within whichever jurisdiction you may operate. And I think that is very, very important. But to us, that's kind of table stakes. That's really what you have to do before you get your product even approved and out of the gate. But
Aaron,
risk.
may I add something here, because I think this is a really important point to understand. When you look at even the most advanced regulation in the world, and again we mentioned MiCA as the latest one, they are not specifying any of these things. They are the only thing that they are saying is it is the responsibility of the organization operating and offering services on top of these platforms to manage the risk. And that's where this becomes challenging and so important, because it is literally on the organizations themselves to make sure that they are doing what they can in order to manage and minimize the risks of interacting with public blockchains.
Yeah, and I think one of our concepts in the first bullet that we have here is, institutions, whether they be traditional financial institutions or digital natives that are scaling up risk management, need to get out of the concept of what do I need to do just to be legal, just to issue my asset, just to get my product live. They need to start thinking more holistically of how do I build a scalable business? How do I implement risk management similar to what I do today in any kind of traditional institution, which involves more than just screening transactions and screening wallets. And that's really what our mindset shift is that we've been having with clients is, hey, you need to start to think about how do you manage your business? If you rely on this infrastructure and it's vital to how you operate your day-to-day, the requirements that you run may not be in a law or in a regulation somewhere, but it may be something that you're required to do. What we have seen going back probably 3 to 4 years is, historically people, manually would go in and look and see, on a quarterly basis, were there any network updates or anything published by a network? There was very, very manual processes. Even in the analytics side of the house, they would screen transactions manually on an ongoing basis, but there's been a shift from, as the infrastructure and the service providers have matured, from more manual monitoring capabilities to more automated, and we'll touch on AI a little later as well, but really getting these monitoring capabilities closer to real time. And we have that at the top of this slide because if you think about what the future of what blockchain and risk management looks like, it's real-time monitoring on a block-by-block, transaction-by-transaction basis, your network, your transactions, your smart contracts, and having your institution be able to respond extremely fast to those incidents. We alluded to it before, but you're not going to be able to sit there and watch Discord and look at Twitter to identify all of the crypto cybersecurity incidents that may occur. You're going to need that in-house risk management capability, and that's really what we've been trying to work with digital native service providers as well as traditional institutions to start to build out. I'll reiterate it again. I think there are different types of monitoring that your institution will require. If you're building in this space and you plan to build on public blockchain infrastructure, you need to understand what is your liability, what are the third-party service providers that you're using, what do they need to do, what do they need to monitor in order to sufficiently mitigate the risk that you're taking. A lot of this is new, a lot of the technology and the services are still evolving, but we do think each institution has to own that responsibility. And lastly, as we look at the future, and if you start looking at a lot of the regulatory publications that are coming out, whether it be from global, prudential regulators, whether it be from U.S. regulators, even within MICA some, you start to see this requirement of how do you ensure that you have sound operations and effective risk management as a regulated institution if you're going to use public blockchain infrastructure. And I think the expectation a lot of times is, oh, I've built a great product, I'm going to deploy it, look, it works great. But at the same time, you kind of ignore what are my risk management responsibilities and how do I ensure that I have the same level of operations, especially if you're responsible for customer funds and you have a fiduciary liability to ensure that you can do that. We think that enhanced monitoring can help bridge that gap. It can show how can I leverage the infrastructure, get all the benefits that Brian alluded to, while also ensuring that I'm not taking on risk that really isn't within my risk appetite or within my risk threshold. So we'll step into, on the next slide, what we mean by each of these types of monitoring, followed by really the how. How have we seen this come into play? So to step into the summary, we'll start with network monitoring. So this is really focused on how do you monitor the health of the network and the function of the consensus layer, right? This is really the settlement and execution. So a lot of times what institutions that might leverage this, so if I'm a stablecoin issuer, I deploy my smart contract on the network, and I rely on that network to conduct those transactions, right? That the network is essentially providing me with the settlement and the execution layer via whatever consensus mechanism it might be. One way that I could monitor that might be looking at gas fees, might be looking at transaction speeds, might be looking at the validation of centralization. If there's a huge shift, depending on whatever consensus mechanism you might be looking at, proof of work, proof of stake, you need to monitor that in order to identify whether or not there's an impact on your operations. So I think it's vital that we acknowledge there is a responsibility. There's no, as we alluded to before, there's no SLAs. There's no contract with the network. So what that does is it turns the responsibility from that counterparty, where historically you may have had a contract saying you're required to do X, and if you don't do it, then I'm going to come sue you, to now each individual participant potentially has the liability to do that, or to kind of perform that monitoring, to say, I know that from my risk management capabilities, those are in place. So from a risk perspective, that's really important for ensuring that your operations are able to continue, and also from a reputational standpoint, it doesn't matter if I'm Joe Schmo and I want to issue a stable coin. If Ethereum goes down and my clients are my clients, they come to me and they say, why can't I transact? You can't tell them, oh, the network went down and there's nothing I can do. You essentially are providing that service to your clients, and so it may impact your reputation, even if legally you may not be, you may have no liability. So from a network perspective, there's a lot of providers out there. You have things like Coinmetrics, Glassnode, others that are able to kind of provide you that data, but you still have to have the capability to ingest it, understand it, and set up the monitoring capability. Next, we'll talk about transaction monitoring. So this is probably the most well-known and common in the space. It's really around how do you monitor the asset or the set of wallets that you're leveraging for suspicious activity or compliance with laws and regulations. So a lot of times this is where you have compliance functions and legal functions saying, within these jurisdictions, I may be registered, I have to comply with Bank Secrecy Act like rules, travel rule, things of that nature, where there are some very, very good analytic shops that continue to evolve. And even if you look at elliptic Chainalysis, you look at things like Nota Bene, those are shifting from very sophisticated detect capabilities now into prevent capabilities. And I think AI will help that along the way as well. So it's very interesting to see how this transaction monitoring space evolves. But I think this is probably where the industry is in a good place. We're getting there. but as we shift into the other three components, we need to be conscious of that. The next is smart contract monitoring. This really has to do with monitoring the function calls and any changes to the administrative users related to smart contracts, either that you have deployed or smart contracts related to assets that maybe you offer to your clients. I think it'll be very interesting to see how this evolves. This more involves risk around how do you manage your information technology and cybersecurity around how do you ensure your smart contracts operate as intended. We've seen some really cool things like Forta agents that you can design and deploy on-chain. We're also seeing AI come into this space as well with being able to monitor your smart contracts and detect anomalies and suspicious activity. So expect to see this grow quite a bit in the next couple of years as large institutions start to leverage these networks and use the power of smart contracts. Lastly is asset monitoring. So this is really around the concentrations and use cases. These really determine the price or trading pairs of an asset. If I'm an asset manager or an exchange or a custodian, I need to understand what are the price, liquidity, and reputational risk that an asset presents. And there's some really, really good providers that have been around a long time. You look at your CoinMarketCaps, CoinGecko's, now there's pretty bespoke offerings that will look at cross-exchange pricing to get you the best available data that you can, but you need to be able to monitor these assets in real time. So the next question that we often jump to is, how do I actually do this? So it can be a little overbearing at times. As we alluded to before, you need to look at it from what are the products, what are the services that your institution is looking to offer, and take it on a product by product basis. Normally what we do with clients when we sit down is we say, let's define what is the infrastructure that you're using, what are the third parties, what is, at the end of the day, what is the life cycle of that product, what risk, what new and incremental risk do these products, this infrastructure present to you as an institution, and then what do you need to monitor? It could be monitoring a network, it could be monitoring a smart contract. What are these new risks? Can you identify the events and the triggers that you would need to monitor related to this network or this smart contract that would impact your operations? So a good example is if you're going to deploy onto a network, there's new risk around governance. Everyone's heard of forks. Everyone's heard about transaction throughput and increases in network centralization. I think identifying these events and these triggers will be very, very important for how your risk management function operates. So if I'm a stablecoin issuer, I may need to look at smart contracts as well as the network. I may also have a component of transactions, and I may also need to monitor the use cases and the concentration of my stablecoin across the networks to effectively use my risk management. What's very interesting is once you determine the events and the triggers that you determine your institution needs to monitor, you can then determine what is the data I need in order to actually facilitate and monitor those events. And that's really where you get into the tooling. And so a lot of times clients have to decide, do I want to build a proprietary solution or do I want to leverage a third-party service provider? Do I want to leverage a data provider? Do I want to leverage a compliance analytics provider to do a lot of this stuff? But what's really important is that those events and those triggers can be quantitative and they can be qualitative, and they require expertise from across an organization. You need compliance folks, cybersecurity folks, you need your operational folks to come in and really do a comprehensive assessment of what are all the events and triggers that we need to look at to make sure that we're effectively managing that risk. The tooling, as Brian alluded to, continues to evolve in a really, really fast and robust way, and it's improving. I mean, it's incredible the amount of clients that we have coming to us saying, hey, we have a new product that's around smart contract monitoring or network monitoring. So we know that it's there. A lot of times clients often just look at it in silos and they don't look at it comprehensively. How do I manage the risk at a network level or at an asset level? So what we're going to do is try and bring this to life and step through a few specific use cases. These are going to be simplified use cases. They're at a high level, intended to kind of give you an understanding of like how would this work if I was in a certain scenario. So I think we'll step through 3 examples quickly, and then at the end we'll kind of give a recap. So starting with one of the more common network use cases that we see, really around protocol updates. So for anyone who's been in this space for any amount of time, when you have decentralized infrastructure, managing protocol updates and thinking about the potential for forks has been a new concept for a long time. So in this first example, we think about if you tokenize an asset and you deploy it on a public network, you essentially need to monitor that network to see, are there any updates, are there any forks, is there anything that would impact my ability to conduct my operations and service my asset on that network. Generally, when we think about network updates, there's really 4 simplified steps. You have a governance proposal, a governance vote, you have the propagation of the upgrade or the update, and then you have, if it is contentious, there's the potential for a network fork. So if you think about, if I'm an institution operating an asset on that network, I need to identify almost within each stage of this when that occurs so that I can respond. In some cases, my response is going to be, oh, I need to vote. Oh, I need to review that update. Oh, I need to update my nodes. Oh, I need to make sure my node provider is updating there. So you need to actually determine how you would monitor each of these specific events related to governance. One of the complexities of this is there's off-chain components, and anyone who's been looking at the various networks, everyone has a slightly different governance process right now. There's more centralized, there's more decentralized, there's social media, there's different forums on websites. Voting as well is challenging. So I think each of those present their own challenges that every institution needs to manage. I think things like Masari Governor have evolved to kind of fill this gap where you have push notifications or things that your institution can use, but you need to make sure that that's built into your risk management function. You can see at the very bottom, I think the things you would want to monitor related to protocol updates would be new proposals, upgrades, or forks. And then for each of those, you need an alert, and then you need a response book. So your institution needs to be able to say, if this happens, we do this. If this happens, this team does this. So that's really what the future of monitoring looks like. Next, I think Brian's going to walk us through a smart contract example as well.
Yeah, thanks, Aaron. So when we look at this example, so this is if you're an organization that is engaging with a bridge between 2 blockchains directly, so maybe you're an asset manager moving your assets from one chain to another, or you could have a bridge be embedded within a product that you're servicing to a client. So maybe you're a blockchain-based gaming company that facilitates assets on multiple chains, and also, while it's not your technology, you allow your users to engage with the bridge natively within your experience. You'd want to likely be very aware of a few critical components of engaging with bridge contracts. So what we have here is two critical components. One, being able to monitor, is the transaction making its way across the bridge in the number of blocks expected or the actual duration, amount of time? And if not, that there's a trigger or alert, so you make sure you can take action and not necessarily hear from a customer that assets didn't make it there, or that you'd want to have as early of a warning as possible, right? The second consideration would be that the assets that I expected to come out the other side from a bridge perspective into onto the bridge chain, is that in the amount that was planned, right? Obviously net of any sort of fee. So those are 2 critical components when we talk about smart contract monitoring. There are a whole host of complexities that could be introduced depending on the nature of the bridge, the bridge asset, the 2 different blockchains, so a lot of complexity there, but here's just 2 key examples. Timing, as well as the amount of assets to make it to the other side, that organizations certainly are building out the capabilities to monitor that contract and make sure they're aware. So another example we'll talk through is
I don't think we have time for the next example, so maybe move directly to summarize, or maybe 30 seconds. So another example is a pump and dump scheme. Many of these schemes behave in very similar fashion, meaning money comes out of Tornado Cash, is distributed to multiple wallets, an NFT offering is coming out. These wallets are the first ones to buy and the first ones to buy in and the first ones to sell out. As we see this monitoring capability connect also to AI, we are seeing these type of activities being identified in advance because they do have and behave according to similar patterns. With that, let's talk about summarizing in the few seconds that we have left. We believe that institutional grade monitoring and risk management is an integral part of deploying capability on public blockchains. And there's a lot more to do there, and onwards towards the future.
Yep.
This is inevitable.
Thank you. We'll hang around in the back if anybody would like to discuss, but really, thank you very much.
Awesome. Thanks all.
Thank you for listening.